Good morning, everyone. I'm here to provide a summary of Sabre's second quarter 2025 earnings call. Financial highlights for Q2 2025. Revenue. Sabre reported revenue of $687 million, a decrease of 1% year-on-year. This was primarily due to a $5 million decrease in distribution revenue, driven by lower air distribution bookings, partially offset by an increase in hotel distribution bookings. IT Solutions revenue also decreased by 2% year-on-year due to demigrated carriers, though this was partially offset by growth in passengers boarded and license fee revenue. Profitability. Normalized adjusted EBITDA for Q2 2025 increased by 6% year-on-year, reaching $127 million. The normalized adjusted EBITDA margin saw an expansion of approximately 120 basis points, reaching approximately 19%. Gross margin. Normalized gross margin decreased by 110 basis points compared to the prior year. This was attributed to foreign exchange impacts from a weaker US dollar and a stronger mix of US bookings, which carry a lower margin profile. Free cash flow. Pro forma free cash flow was negative $2 million. It's important to note that reported free cash flow of negative $240 million included a $227 million impact related to refinancing activity. The company expects to generate positive pro forma free cash flow in the third quarter. Key performance metrics and operational updates. Air distribution bookings. These declined by 1% year-on-year, underperforming previous expectations of low single-digit growth. This shortfall was attributed to industry weakness emerging in June and continuing into July, particularly impacting corporate and government/military travel, which are areas of higher exposure for Sabre. Growth strategies contributed 8 points of growth, but this was offset by a 9-point decline in the base business. Hotel distribution bookings. Growth continued at 2% in the quarter, with the attachment rate to air bookings improving by 100 basis points to 34%. IT Solutions. Passengers boarded increased by 1% year-on-year. The company anticipates continued passenger boarded growth in the second half of the year, with quarterly revenue expected to be in the $140 million to $145 million range. Growth strategies. The company is making significant progress with the implementation of signed new business, which is expected to accelerate in the back half of 2025. Growth strategies contributed over $2 million of air distribution bookings in June and approximately $2.5 million in July, representing approximately 10 points of year-on-year growth. Multi-source content and NDC. Sabre has 38 live NDC connections, among the most in the industry, with seamless shopping, booking, and workflow integration. The company believes its multi-source offering is the best in the marketplace and is a key driver for signing new business. Digital payments. This business continues to scale rapidly, with Q2 gross spend of $5 billion, up 44% year-on-year. AI-powered offer management. The company is seeing strong traction with its IQ products, signing an agreement with Avalo Airlines for ancillary IQ, bringing the total to 9 airlines utilizing Sabre Mosaic offer management products. Management's forecasts and outlook. Revised 2025 outlook. Due to the observed weakness in the first half and uncertainty in GDS industry growth, Sabre has revised its full-year air distribution bookings growth forecast to be flat to low single digits. Second half 2025 air distribution bookings growth. The company now expects a range of 4% to 10% growth. Third quarter 2025 forecast. Air distribution bookings growth is forecast to be between 2% and 6%, resulting in year-on-year revenue growth of low to mid-single digits. Pro forma adjusted EBITDA is expected to be in the range of $140 million to $150 million, with pro forma free cash flow projected between $40 million $150 million. Fourth quarter 2025 forecast. Air distribution bookings growth is expected to accelerate to 6% to 14%. Full year 2025 financial outlook. Pro forma revenue is expected to grow flat to low single digits. Pro forma adjusted EBITDA is projected between $530 million and $570 million. Pro forma free cash flow is expected to range from $100 million to $140 million. Long-term growth. Assuming a flat GDS market beyond 2025, Sabre projects its air distribution volume growth for 2026 to be in the high single digits, based on current execution. Significant risk factors. GDS industry weakness. The ongoing underperformance of GDS volumes, particularly due to the mix of corporate versus leisure bookings and the pullback in government and military travel, poses a significant risk. Sabre's higher exposure to these factors compared to competitors exacerbates this risk. Sabre mix. Sabre's higher share in certain countries experiencing disproportionate travel declines, and lower share in better-performing countries, is a headwind. Growth strategy timing. A temporary delay in the launch of a new multi-source low-cost carrier solution, due to technology and connectivity development, has pushed the expected launch to early 2026, impacting anticipated growth in the second half of 2025. Foreign exchange and booking mix. FX impacts and a stronger mix of U.S. bookings have negatively affected gross margins. Highlights. Balance sheet strengthening. Sabre has made significant progress in strengthening its balance sheet by growing adjusted EBITDA, extending debt maturities, and paying down debt. Nearly 60% of debt is now maturing in 2029 and beyond, and total debt has been reduced by over $1 billion this year. Growth strategy momentum. Despite industry headwinds, growth strategies are scaling as expected, with clear visibility into new business realization. Technology transformation. The company continues to transform its platform into a modern, open travel marketplace and is making progress with its technology initiatives. Cost management. Sabre is maintaining strong cost discipline, with technology costs expected to be down measurably for the year, and SG&A costs likely to be down slightly. Lowlights. Underperformance in air distribution bookings. The 1% year-on-year decline in air distribution bookings fell short of expectations, primarily due to industry-wide challenges. Revised outlook. The updated outlook reflects the near-term pressures experienced in the market. Delayed LCC solution. The 6-month delay in the multi-source low-cost carrier solution will impact growth in the latter half of the year. Most important statements from management. Kurt, President and CEO. In what has been a dynamic and at times challenging first half of the year, we have remained focused on executing our strategic priorities. First, to generate free cash flow and delever the balance sheet, and second, to drive sustainable growth by delivering innovative technology solutions for our customers. Despite this near-term pressure, we are staying focused on executing and making steady progress against our strategy, which we believe best positions Sabre for long-term growth. We are making significant progress against our strategy and transforming the business to capture long-term value in a dynamic and evolving travel marketplace. We are navigating some near-term challenges that we believe are largely transitory, and we are encouraged with the continued scaling of our new business volumes. Mike Randolphi, Chief Financial Officer. Based on the second quarter bookings shortfall and lower gross margins, adjusted EBITDA was approximately $20 million lower than our expectations, which also impacted free cash flow. This year, we have paid down over $1 billion of total debt, reducing our expected year-end pro forma net leverage by approximately 50% as compared to 2023. We expect to generate positive free cash flow in the third quarter on a pro forma basis in a range of approximately $40 million to approximately $50 million. Our goal would be, as we grow air distribution bookings, we'd look for a good portion of that gross profit to fall to the bottom line as a result of the cost discipline that we continue to have. In closing, Sabre is working through some near-term industry headwinds, but remains committed to its strategic priorities of deleveraging and driving growth through innovation. The company expects improved performance in the second half of the year and into 2026,